Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Thursday, the 5th of January. I'm Daniel Lam, your host for the podcast. Today, I would like to switch gear and talk about fixed income. While the moves in the Hang Seng Index and the dollar-yen were grabbing most people's attention, the US 10-year government bond yield is also very interesting right now. If you look at the technical chart, you will notice that it hit resistance at 3.9, in fact twice over the last 6 weeks, and then went lower on both occasions. The momentum indicators, such as the Directional Momentum Index, i.e. the DMI, as well as the MACD, are both showing bearish crossover, which means that the US 10-year government bond yield may have further downside to come in the near term. Now, if you look at the fundamentals, growth concerns are back in the spotlight, pressurizing the US 10-year government bond yield. Earlier this week, WTI posted its biggest drop since the middle of November 2022, following an increase in OPEC's crude output last month. Elsewhere, there was a deeper contraction in the China Caixin manufacturing PMI, which underscored the short-term pain from the abrupt easing of mobility controls. Now, we believe there is a 70% probability that the US may enter recession this year. The Fed's ex-chairperson, Alan Greenspan, highlighted that a recession is the most likely outcome of the Fed's monetary tightening. And he does not believe the Fed to relax policies too soon. With this backdrop, we would like to highlight our preference of fixed income over equities from our 2023 annual outlook. We believe US 10-year government bond yield may go to 3.25%. Combining with a slowing growth or recessionary environment, investors should rotate their exposure to high-quality income assets. They should consider extending the duration of their portfolio as well, as falling yields favor longer-dated bonds. Now, in terms of allocation, for an investor with a global moderate risk profile, our overweight in fixed income is mainly funded from our underweight in equities. So our foundation tactical asset allocation model suggests an allocation of 55% of your portfolio into fixed income, which is 10% higher than the strategic asset allocation at 45%. In comparison, we're recommending a 21% tactical asset allocation into equities. That compares to a 30% allocation under the strategic asset allocation model. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.